Imagine you just spent $500,000 to buy yourself a job that pays $8 an hour. You were told it was an asset. You were told it was a passive income machine that would deposit checks into your account while you sipped margaritas on a beach in Cabo. But instead of the beach, you are in your guest bathroom at 10 o'clock on a Tuesday night, trying to figure out why a traveller from 3 states away cannot understand how a standard shower handle works. This is the reality of the Airbnb bust. For the last decade, we have been living in a dream fueled by 0% interest rates and a tidal wave of social media hype. We were told that short-term rentals were the ultimate hack to financial freedom. But the numbers are finally coming in, and they are brutal. We are witnessing a massive structural shift where thousands of amateur investors are realizing they didn't build a business. They just accidentally applied for a high-stress, capital-intensive, minimum wage position in the hospitality industry. If you have been thinking about jumping into the rental market, or if you are currently holding a property that feels like a weight around your neck, we need to have a very honest conversation about the math of your time. I have spent the last few weeks digging through the data from AirDNA, the Wall Street Journal, and real-world profit and loss statements from hosts who are seeing their calendars go grey for the first time in years. What I found is that the gap between the dream and the data is wider than it has ever been. Before we dive into the granular breakdown of the hourly wage of a host, I want to ask you for the best return on investment you can make today. It takes about 2 seconds to hit the subscribe button, and it costs you exactly $0. In return, I will keep doing the deep dives into the financial reports so you don't have to. It is the only truly passive way to keep your financial literacy sharp. I have noticed that most people watch these videos, but forget to lock in their spot in the community. Don't be that person. Hit that button and let's get into the first big myth of the rental world. What passive income actually means. The first step in understanding why the short-term rental market is hurting is to admit we have been lied to about the word passive. In the world of real financial literacy, passive income has a very specific definition. It is money earned from an enterprise where you do not materially participate. Think about an S&P 500 index fund. When you buy a share of that fund, you are literally doing nothing. Thousands of CEOs, millions of employees, and billions of dollars in research and development are working on your behalf. You sleep, they work, and you collect dividends. That is the gold standard of passive. But somewhere along the line, hustle culture took over and rebranded the second job as passive income. They told us that if the work happens on an app, it doesn't count as labor. They sold us on the idea that managing a property is just a series of clicks. But if you are the one answering the messages, if you are the one coordinating the cleaners, and if you are the one worrying about the 5-star review, you are materially participating. You are a business owner, and your time has a cost. If you ignore that cost, you are lying to yourself about your actual returns. Let's look at the math of human capital. Most novice investors only look at cash-on-cash return. They see a property that brings in $10,000 a year in profit, and they think they are winning. But they are forgetting to audit the most expensive asset they own, their own hours. If you spend 500 hours a year managing that property, you haven't made $10,000 in profit. You have simply paid yourself $20 an hour for a job that requires you to be on call 24 hours a day. From a personal finance perspective, this is a dangerous trap. It artificially inflates your perceived success. If you could have earned $40 an hour at your day job or by consulting, you actually lost $10,000 in opportunity cost by running that Airbnb. This is what I call the human capital leak. In the early days of the short-term rental boom, the margins were so high that you could afford to ignore this. When you were making $50,000 in profit, the labor felt worth it. But as the market saturates and the revenue drops, that labor stays the same. The work of managing one guest for a $100 night is exactly the same as the work for a $500 night. The profit evaporates, but the job remains. Even the IRS has a more realistic view of this than most TikTok influencers do. For tax purposes, rental activities are generally considered passive, but there is a massive exception for what they call real estate professionals, or those who provide substantial services. If you start providing breakfast, daily cleaning, or guided tours, the government suddenly sees you as a business, not an investor. And that is the psychological wall many hosts are hitting. They realize too late that they are actually running a decentralized boutique hotel. In a hotel, there is a front desk, a cleaning crew, a maintenance department, and a general manager. In an Airbnb, you are all four of those people. You are the head of customer service and the director of housekeeping. When a guest can't find the extra towels at midnight, you are the person who gets the ping. This is not a real estate play in the traditional sense. Traditional real estate is about long-term appreciation and stable tenants who bring their own furniture and change their own light bulbs. Short-term rentals are a service business that happens to have a house attached to it. If you treat it like an investment, you will fail at the service. If you treat it like a service, you will realize how little you are actually making per hour. So, what is the protocol for fixing this mindset? It starts with a ruthless time audit. I want you to stop tracking your revenue for a moment and start tracking every single minute you spend on the property. Every text message to a guest, every trip to the hardware store for a specific light bulb, and every minute spent staring at the pricing algorithm counts. At the end of the month, divide your net profit by those hours. If that number is lower than what you make at your primary career, you are not investing, you are moonlighting. The solution for many is to move back toward truly passive vehicles, or to transition the property to a long-term rental where the labor requirement drops by 90%. We have to stop romanticizing the grind and start valuing the peace of mind. True financial independence isn't about how many properties you own. It is about how much of your day you actually own. If your assets require you to answer your phone during dinner with your family, they aren't assets, they are bosses. We are going to look at why this problem is getting worse because of the macroeconomic supply shock. But first, you have to decide if you want to be an investor or a hotel manager. There is no middle ground anymore. Now here is where it gets worse. If you think managing the property is hard, wait until you see what the competition is doing to your bottom line. We are currently living through a massive supply shock. During the pandemic, everyone had the same bright idea at the same time. People saw the remote work trend and the desire for domestic travel, and they flooded the market. According to the data from AirDNA, active listings in the United States hit record highs in 2023, surpassing 2.4 million units. That is an incredible amount of inventory hitting the market in a very short window. Basic economics tells us that when supply outstrips demand, the price has to drop. But in the short-term rental world, it is a double whammy. Not only are prices dropping, but vacancy rates are climbing. Your fixed costs stay the same, whether the house is empty or full. You still have to pay the mortgage, the insurance, the property taxes, and the landscaping. This means your margin for error has basically vanished. You are fighting for a shrinking pool of travellers who are also feeling the pinch of inflation and are becoming more demanding and price-sensitive than ever before. The gold rush is over, and we are left with the ghost towns of the digital age. In the hospitality industry, there is a metric called RevPAR, which stands for Revenue Per Available Room. It is the most honest way to look at how a property is performing, and right now, RevPAR is in a tailspin in major markets. Hosts who used to get $300 a night are now lucky to get $180. At the same time, the cost of everything else is up. Property insurance for short-term rentals has skyrocketed because insurance companies have realized how much damage a rotating door of vacationers can do. Utilities are up, cleaning supplies are up, and if you bought your property recently with a high interest rate, your debt service is likely double what it would have been 3 years ago. This is the simple but brutal math of the Airbnb bust. Lower nightly rates, multiplied by lower occupancy, minus higher operating costs, equals evaporated cash flow. This is why you see so many people on forums complaining that their calendars are empty. It isn't a glitch in the algorithm, it is the market reaching a state of equilibrium. The amateur era is being crushed by the weight of professional supply. If your property doesn't stand out as a top 5% experience, you are essentially competing in a race to the bottom on price, which is a race no one ever really wins. Many people are trapped because they bought into the market using leverage at the wrong time. If you have a mortgage at 7%, your house has to perform like an elite athlete just to break even. This is where the opportunity cost trap becomes a sinkhole. Some investors are holding on to these properties because they don't want to admit they made a mistake. They are subsidizing a failing business with their day job income. They tell themselves that the property will appreciate in value, but appreciation is never guaranteed, especially when local governments are starting to pass strict regulations that could ban short-term rentals entirely in your area. If your city bans Airbnbs tomorrow, the value of your home drops instantly because it can no longer generate that premium revenue. You are left with a high-interest loan on a property that might not even cover its own costs as a long-term rental. This is why financial literacy is about more than just spreadsheets. It is about risk management. The risk-adjusted return on an Airbnb right now is, frankly, terrible compared to almost any other asset class. You are taking on massive debt and massive labor for a return that is increasingly looking like a gamble. If you are already in the market, the protocol for survival isn't to work harder. It is to get smarter about your positioning. You have to move away from the generic. If your property looks like an IKEA catalog, you are a commodity. Commodities are sold on price. You need to either find a niche, like midterm rentals for traveling nurses, or you need to exit before the market gets further saturated with desperate sellers. The most important step is to stop listening to the influencers who are still selling courses on how to get rich with rental arbitrage. They are selling you a map to a gold mine that has already been tapped out. Instead, look at the professional hospitality data. Look at what actual hotels are doing. They are cutting costs and focusing on loyalty. If you can't compete with a Hilton on price or service, you shouldn't be in the hotel business. We are going to break down the exact hourly wage calculation in a minute, but first, realize that the macro environment is no longer your friend. The wind is now in your face, not at your back. This is the retention reset. If you think the nightly rates are the problem, wait until you see the cleaning fee paradox. But before we get to the grime, let's talk about the guests. Managing guests is the most emotionally draining part of this business. We live in an era where people expect Ritz-Carlton service on a Motel 6 budget. Because of the rating system, the guest holds all the power. A single 4-star review can bury your listing in the search results. This creates a power imbalance where you become a servant to the algorithm. You have to be responsive 24 hours a day. If a guest can't find the Wi-Fi password at 2 in the morning, your phone buzzes. If you don't answer within 10 minutes, the algorithm flags you for poor responsiveness. This constant tethering to your smartphone is a hidden cost that no one talks about. It is a form of cognitive load that prevents you from focusing on your actual career or your family. You are never truly off the clock. I have talked to hosts who have panic attacks every time their phone pings because they are worried it is another complaint or a guest who can't figure out how to lock the front door. This is the hidden tax on your mental health. Then there is the cleaning. The common advice is to just hire a cleaning service and pass the cost to the guest. But in reality, managing cleaners is a logistical nightmare. You have a 5-hour window between checkout and check-in. If the cleaner's car breaks down or they get sick, you are the backup. You are the one who has to drive over there and scrub a toilet so the next guest doesn't leave a scathing review. And guests are fighting back against cleaning fees. They see a $100 nightly rate and a $150 cleaning fee, and they feel cheated. To stay competitive, many hosts are now absorbing part of that cleaning cost. That means you are paying a professional cleaner more than you are actually making in profit for that night. You are literally paying for the privilege of having someone stay in your house. Furthermore, you have to manage the inventory. You have to order the toilet paper, the coffee pods, and the little soaps. You have to track the invoices. You have to check the work to make sure they didn't miss a hair on the sheets. This is quality control management, and it takes hours of administrative work every single week. The wear and tear on a short-term rental is exponentially higher than a long-term rental. Vacationing guests are hard on houses. They drag heavy suitcases across hardwood floors. They run the air conditioning at 60 degrees with the windows open. They flush things down the toilet that no human should ever flush. In a long-term rental, if a dishwasher breaks, you have a few days to fix it. In an Airbnb, if it breaks, the guest demands an immediate refund or a repairman on site within the hour. This means you have to pay the emergency premium for every single repair. You are paying a plumber $200 to show up on a Sunday because a guest was careless. When you add up the time spent finding contractors, coordinating their entry, and verifying their work, you are looking at another 5 to 10 hours a month of high-stress management. This is the maintenance treadmill. You are constantly running just to keep the house in the same condition it was in yesterday. From a financial perspective, you are essentially trading your time for the slow decay of your asset. The protocol for reclaiming your time is simple but hard. You have to automate or eliminate. If you can't use digital locks, automated messaging, and a professional management company that takes the middle of the night calls, you shouldn't be doing this. But here is the catch. Once you pay for those automations and that management, your profit usually disappears. Most property managers charge 20 to 30% of your gross revenue. In today's market, that is often your entire margin. This brings us back to the core realization. The business only works if you provide free labour. If you have to pay a fair market rate for the work, the investment fails. This is a classic sign of a bad business model. A good business should be profitable after paying for all the labour required to run it. If it only works because you are working for free, you don't own an investment. You own a job where you are the most underpaid employee. We are going to run the final numbers now to show you exactly how this looks on paper. Let's do the cold hard math. Imagine a property that brings in $44,000 a year in gross revenue. After you pay the taxes, the insurance, the utilities, the platform fees, and the maintenance, you might be left with $25,000 in net operating income. Now, subtract a mortgage of $20,000 a year. You are left with $5,000 in actual cash profit. That sounds like a nice little bonus, right? But now, let's look at the time. If you spend 67 hours a month managing that property, that is 800 hours a year. $5,000 divided by 800 hours is $6.25 per hour. Even if you are a superstar and you double your profit to $10,000, you are still only making $12.50 an hour. You are working for less than the minimum wage in many states, and you have $100,000 of your own capital trapped in the house. This is the tragedy of the Airbnb bust. People are risking their life savings to work a part-time job that pays less than the local fast food joint. And they are doing it with a smile because they think they are real estate moguls. This is why financial literacy is the ultimate shield. It allows you to see through the glamour and see the wage for what it really is. Before I give you the final exit strategy and the better alternatives, I want to invite you to join a specific group of people who are looking at these numbers correctly. We call them the optimizers. If you look below this video, you will see a join button. By becoming a member, you help support these deep dive reports that cut through the marketing fluff. You get priority in the comments where I answer your specific questions about your own portfolio, and you get a special badge that shows you value data over hype. We are building a community of people who want their money to work for them, not the other way around. If you have found value in this breakdown so far, Clicking that join button is the best way to ensure we can keep producing this kind of content without having to sell you a fake real estate course. It is a small investment in your own financial education that pays off every time you avoid a trap like the Airbnb bust. Now, let's look at what you should be doing with that $100,000 instead. What is the opportunity cost of that 800 hours and that $100,000? If you put that same money into a boring index fund, you would likely earn 9% a year. That is $9,000. And the amount of work required is zero. Your hourly wage is literally infinite because you are doing no labor. You would be $3,000 richer and 800 hours wealthier in time. You could use those 800 hours to learn a new skill, grow your primary business, or just be a present parent. In the world of finance, we call this the risk-adjusted return. To get that extra bit of potential profit from the Airbnb, you are taking on massive operational risk, regulatory risk, and physical asset risk. In the current environment, the spread between a risk-free treasury bill and a high-stress Airbnb is so narrow that it makes no sense to take the risk. We have entered a period where the simplest path is often the most profitable. Don't let the complexity of property management fool you into thinking it is a superior strategy. Sometimes the smartest thing you can do is the most boring thing. So, what is the exit protocol? If you are in a property that is paying you minimum wage, you have three options. First, pivot to a long-term rental. You will take a hit on the gross revenue, but your expenses and your labour will vanish. Most landlords spend less than 10 hours a year on a good long-term tenant. Second, sell the asset and reallocate the capital into a truly passive vehicle while the market still has some liquidity. Don't wait until everyone else tries to sell at the same time. Third, if you are determined to stay in hospitality, you must professionalise. Hire the manager, accept the lower margin, and treat it like a diversified part of a much larger portfolio. The biggest mistake you can make is to stay in the middle, working like a dog for a return that doesn't justify the effort. My goal for you is to decouple your time from your money. That is the only way to achieve true wealth. Short-term rentals, for most people, have done the exact opposite. They have tethered people to their property more tightly than a 9-to-5 job ever could. Take a look at your P&L this weekend. Be honest about your hours. If the math doesn't work, don't be afraid to walk away. The best investors aren't the ones who never fail, they are the ones who know when to cut their losses. I want to hear from you in the comments. This is our version of a peer review. If you are a host, I want you to be brave and share your actual hourly wage. Have you done the audit? Have you noticed your vacancy rates climbing? Sharing your data helps everyone else in this community make better decisions. We learn more from each other's real-world P&L statements than we do from any textbook. Let's start a conversation down there about the reality of the market in 2024. And if you haven't yet, make sure you hit subscribe. I will see you in the next one. Keep your time yours and your math honest.